Hi everybody, welcome back to another video. So in this video, I'll go through the recent earnings of Mapletree, Pan Asia Commercial Trust and Fraser Logistic and Commercial Trust. Both REITs are quite solid, but we will analyze on the risks and rewards that can be observed based on their recent earnings. For those who are new to my channel, I'm Ben who analyze on different companies. So if you have any companies that you would like me to analyze on, please do the comment below. Thank you, and let's get on with the analysis. Mapletree Pan Asia Commercial Trust is one of the bigger REITs in Singapore at 16.5 billion asset under management. They are also under the good and reliable sponsor Mapletree with asset classes in retail, business parks, and offices. What makes them so unique is that they have larger assets in Singapore for both commercial and retail. I feel that these two sectors are unique in Singapore due to the high density country and working culture. Post-COVID was definitely another factor that has helped Mapletree Pan Asia Commercial Trust in the retail sector's performance. So if you look at their properties, they have the most number of properties in Japan, which can be a good or bad thing for investors. Good is that the debts taken in Japan will be very cheap due to the low interest rate in the country. But the constant drop in the currency for the yen to SGD will also be a problem for the REIT. Next, the good thing is that the management salary is based on the distributable income and the growth in the DPU. This will definitely help to align both the interests of the shareholders and the management in growing the REIT rather than just paying the management with a fixed fee. Looking at the results, if we see the full financial year, gross revenue and net property income was higher across the board for each individual sector. But Singapore properties seems to be the one standing out, which is expected. I think if you go to Singapore malls, especially Vivo cities, you will see that it's usually very crowded. So this is actually a very good thing for the REIT as it will have more profits. But if we see the balance sheet, even though revenue and net property is up 16 and 15.2% respectively, distributable income up 5.2%, but the dividend still drops by 7.3% for the full year. On the bright side, this quarter's dividend is higher year over year by 1.8%. Looking at the reasons for the drop in the DPU year over year, share dilutions is one of the main reasons. Property expenses and interest payment for their debts also went up by 18.5% and 39% respectively. The increase in the utility cost is another factor that is affecting all REITs. MPACT makes it even more obvious by stating a huge increase of 51.5% in their utility expenses. Now, the main issue or risk with this REIT is that it has 31% of its net property income contributed by both China and Hong Kong. But on the bright side, even though their economy is not doing well, the NPI for these two countries surprisingly came in higher. My concern will be the instability in Hong Kong with the new securities law, and we will not know when there will be another riot that happened back in 2019. So this is one risk that I feel that investors can consider when it comes to investing in MPACT. Of course, another common risk is the decrease in the foreign currency strength versus Singapore dollar, as 40% of the income comes from overseas. For the debt wise, it looks more risky due to its high leverage ratio at 40.5%, while the adjusted interest coverage ratio is only at 2.9 times. For all REITs, the limit they can reach is 50% for leverage ratio, while the interest coverage ratio must be more than 2.0 times. However, if the leverage ratio is too high, lenders might be hesitant in lending, therefore it's important for REITs to manage their leverage ratio. The cost of debt is at 3.35%, which is higher than MIT or MLT, which I analyzed on my previous video. This is expected due to the lower corporate ratings and the exposure of properties of MPACT. This plays a part when taking loans from lenders because They will see how risky is the REIT and they will charge a higher interest if they deem it riskier. For the debt maturity profile, they have a lot of loans to renew in the next few years. They have recently also issued green notes of 200 million at 3.9%, which is much higher than the current reported average of 3.35%. So definitely when they refinance these new loans, it will be higher than the current reported average of 3.35%. This might be a risk in increasing their interest payment of their debts, thus would definitely negatively affect their DPU. On the bright side, the retail side is coming in strong in Singapore portfolio. As you can see, the VivoCity have a 2.6% and 10.1% higher in tenant sales and shopper traffic respectively. Hong Kong retail sales wise is quite quiet with not much changes. Looking at the rental reversion, which is the new rates for the tenants, Singapore and Korea is performing well with positive rental reversions. However, Hong Kong, China and Japan is not performing well with negative rental reversions. Negative rental reversions is not good as the management have to lower rental prices in order to attract tenants. Therefore, this is an example of why Singapore properties tend to stand out and perform better compared to the rest of the country properties. Of course, the country economy plays a big part, and if Hong Kong, China and Japan can recover, MPACT will definitely benefit from it. With the current share price, the expected dividend is around 7% with quarterly dividends. But like I always said, if you want to be more conservative, you can assume drop in dividend due to various factors I mentioned just now. It's important to buy the share at the right price and the appropriate dividend yield. If you have enjoyed the video so far, please support the channel by hitting the like, subscribe, and comment on what you feel about MPACT as well. Thank you, and let's continue with the video. Let's go on to the next REIT, and that is Fraser Logistic and Commercial Trust. For those who are new to FLCT, they are a REIT focusing on logistics and commercial, with logistics being the majority of the assets. The management have also constantly mentioned about the focus on properties of logistic and industrial, which performs much better than commercial, as you can see from the occupation rate. However, they are a REIT owning essentially all overseas properties. So the main concern I constantly mention about FLCT is that as long as the Singapore currency continues to strengthen, this will definitely negatively affect the dividends given by this REIT. Of course, vice versa, if the foreign currency strengthens against Singapore dollars, this will be good for the shareholders. They have also expanded their logistic properties by purchasing additional 4 properties in Germany. With their specialty in managing logistic and industrial properties, is definitely a good move for the REIT. Revenue and net property income increase, but the finance costs also increase, which is expected. We will see their depths on why is it, and it may even go higher later on. So when the increase in the finance cost is higher than the increase in the net property income, the distributable income will definitely drop. Even with the inclusion of 13.5 million extra divestment gain, the DPU still came in 1.1% lower. Next, looking at their debts, the main issue is the debts maturing soon. With other REITs refinancing at 3% and above, FLCT will definitely not be the exception. Moreover, the interest rate of the countries that FLCT properties are in is also way higher than the REIT's current average cost of debt of 2.5%. So this is the main risk, as their finance costs will be expected to increase greatly once the debts in the financial year of 24 to 26 have to be refinanced. So as a shareholder, I will want to cater lower dividends to be more conservative when it comes to investing in FLCT. In my opinion, this is my biggest issue with FLCT, is because they have most of their debts that requires to be refinanced soon in this high interest rate environment. Their cost of debt of only 2.5% will definitely go up. Similarly, for any REITs that you would like to invest in, ensure that in this high interest rate environment, the debt maturity are well spread out. Property-wise, they have been managing very well with logistics constantly having 100% occupancy, while commercial properties is just doing decent at 85%. For rental reversions, it came in decent at average of 10% for the first half with higher rental reversions from Q1 compared to Q2. Similar to my previous video on AA REIT, logistic lease expiry is good for FLCT as they should be able to get very positive rental reversions with their logistic assets. Commercial asset wise will be subjective and we will have to observe on the performances. Looking at the tenant profile, the top 10 tenants are good with the highest only contributing 4.6% and the top 10 contributing a total of 23.1% of the income. Diversity is always good as one tenant unable to pay the rentals will not heavily impact their total income and of course the dividends to shareholders. Overall, FLCT has good management in their properties. The only issues that I have is their huge amount of debts that require to be renewed in the next 3 years. This will definitely increase their finance costs once renewed and the cost of borrowings should be expected to go up. At the current share price, they are giving an attractive dividend yield of 7% paid semi-annually. Thank you so much for watching. I hope this video brings a lot of insights for you when it comes to investing for your dividends. Please support the channel by hitting the like, subscribe and comment on what you feel about the recent Reits results. You can also watch my previous video where I analyze on the recent earnings of the 4 other Reits or on the bank's amazing results. Thank you and I'll see you in the next video.